And again, today we're going to talk about why now is the best time to make a move for probably the next decade. Again, I'm Rob Wachter, and I am the team leader of the Wachter Group, and I am the broker and part owner of JPAR Carolina Living, which is a franchise that we joined in December, and it is based out of Texas, and we've been having a terrific beginning of our relationship there, despite the fact that we have a pandemic going on. We've learned a lot and have really enjoyed being part of that group. I've had 15 years experience before real estate as a banker and financial advisor, so I come to real estate with a slightly different take than some others. I've been a licensed realtor since 2004. I hold designations as a seniors real estate specialist and a strategic pricing specialist. My team is pictured below, as you can see, and I have also served on the Charlotte Regional Realtors Association MLS Advisory Committee and serve as one of the new agent mentors with JPAR Carolina Living. All right, what we're going to talk about today are the economics of what's going on in the world right now, the real estate market, and how this actually applies to you. First thing we're going to talk about is national economic trends. As I'm sure that you are aware, there is a lot of turmoil going on in the economy right now. So we're going to talk about that. First thing I want to bring up is what we may perceive when we hear on the radio, the TV, on the news, how great the economy is doing. The stock market is at an all-time high, which it is. We've had a few hiccups lately, but if you look at this chart, going back about 12 years, the stock market is up nearly 400%. So I don't know how many of us, would be unhappy with that performance. I'm certainly pretty happy with that performance. And looking at it from the outside, it makes it sound like we must have a robust, roaring economy, which we have until recently. And we're going to talk about that in just a second. Now we begin to talk about the effect that the pandemic has really had on this country. And this is what's really important to me to discuss, because I feel like there are things going on that the media, that experts are not necessarily being as honest and direct with the public as they should be. We have, rightfully so, put a lot of stimulus money into this economy. And if you look at what that actually comes out to be so far, as of the middle of July, we've put $2.2 trillion, that's trillion with a T, into the CARES Act stimulus. There has been almost $6 trillion in Federal Reserve stimulus money flooded into the financial markets, which makes a little over $8 trillion in stimulus. And of course, we're not done yet. We're already hearing about other potential things that need to be done. Now, according to the US Bureau of Labor and Statistics, in 2019, there were 141 million tax-paying households in the United States. So by doing simple math, that comes out to a little over $58,000 in federal stimulus money that has been spent so far. Now, I don't know about you, but I haven't seen $58,000 come into my household from the government, but there is a lot of good things that need to be done, and a lot of money does need to be spent. So I'm by no means suggesting that shouldn't be done. The real question is, what happens next, and how do we expect this to be repaid? Well, that's correct, taxes. Like it or not, the government doesn't give away money and leave it away forever. At some point, the piper will need to be paid, and that bill seems to only be going up and getting bigger. So one thing that really struck me when I learned about it this past week is that federal debt is expected to rise in 2021 to exceed the actual gross domestic product of our nation for the first time since World War II. Now, what that means, some of you may understand that intimately. For those of you that don't, that means our country is going to owe more than it makes in an entire year. Now, that has happened before, but it hasn't happened since World War II. It certainly doesn't signal stability and relaxation in the economy. It clearly is an alert that something is going on. And again, that debt needs to be repaid. And what's interesting is people will ask, well, how do we borrow that money? Where does that debt come from? And we're going to talk about that for just a second, because a lot of people hear a lot about mortgage interest rates, and we're going to talk more about that later. But mortgage interest rates trend similarly to the yield on the 30-year Treasury bond. The 30-year Treasury bond is simply a debt instrument issued by the US government that says from the government, if you give us some money, loan us some money, we will pay you back that money plus interest. Over the years, the interest rate on that security has gone from 1.5% to 10, 12%, and it varies greatly depending on the time in the economy. Right now, the yield on that 30-year Treasury bond is only 1.45%. And that's one of the reasons mortgage rates are so low. It's also an interesting indicator, because how does the government convince people to loan it money? By buying these bonds. It makes the interest rates on those securities attractive. The lower the interest rate goes, the less attractive those securities are. One of the concerns that I've got is that the credit worthiness of our nation is, to me, at risk right now. Forget the politics of it. The issues with the pandemic, the stimulus issues, the bankruptcies that are going to affect the financial stability of this country. What that means is, in order to get other people, other countries to loan us money to operate, the interest rates on those securities may need to rise, which I believe is what's going to drive the increase in mortgage rates down the road. Unemployment right now, as of August, our unemployment rate is 8.4%. Now, the thing that's really important to understand in considering unemployment right now is that it is an artificially low number. What I mean by artificially low is there are hundreds, if not thousands, of companies with hundreds of thousands of employees that have taken many of these billions and trillions of dollars in stimulus money with the understanding that they do not lay people off or reduce the workforce. That was, in fact, one of the requirements in taking money from the government. So therefore, we have a number of companies that have more employees than they actually need. If you look at the airlines, if you look at the entertainment industry, there are a lot of companies that have employees that do not need to have them on the books right now, but they have them there because they're required to until a certain date. My belief is once that date comes, you're going to see a dramatic increase in unemployment. In fact, there's a number of companies, especially airlines, cruise lines, that have already made public that they are going to have significant layoffs as soon as the stimulus requirement ends. When you combine that with the pending bankruptcies, the shrinking demand in retail, and the stimulus money, layoffs are only going to get worse. In fact, what is the ideal national unemployment? Well, a year ago, it was 3.6%. So we're more than double now, and I believe we're only at the beginning of it heading up further. So unemployment and underemployment are likely to increase. Bankruptcies are on the rise. Despite all of these federal stimulus packages, 25 major retailers have filed for bankruptcy since this began, including some names I'm sure you know: Lord & Taylor, Neiman Marcus, Pier 1, Earth Fare, a whole number of other companies. And interestingly enough, 6 out of the top 15 bankruptcies that have been declared since this began have been in the oil and gas industry. And that's something that I think is a secret problem waiting to happen, because right now all we see are how low the fuel prices are, and that sounds good to us. But the fuel prices are low because of an artificially low demand. The demand is low because people are not driving as much, because they're working from home more, and of course there's been so many people in quarantine and in restriction. So if we prices and fuel prices are going to rise, and that's going to have a negative impact on your household budget. And I do believe this is just the beginning. What are the unknowns? The future of retail. New car demand is down substantially. Interestingly enough, used car demand is up, mostly because people are trying to save money and not take public transportation. But the demand for spending a lot of money on new cars is down. Travel is clearly down. There are cruise lines that have ships parked and that are costing them hundreds of millions of dollars a month just to have their ships parked. Entertainment is changing. A lot of people are wondering what the movie business is actually going to look like. Are people going to want to go out and go to the theater to see movies? Or are they going to be content at home spending a couple $100s on their big LED TV and be able to sit at home now? Online shopping is skyrocketing. People are having their groceries delivered to their home. Clothing, things that they never would have thought of buying online are now being purchased online because, of course, the perception is that it's much safer. These are all things that are going to change the landscape of everything from our shopping center downtown to malls. Different parts of town that have been predominantly positive and high in property values, I believe, are going to be affected the fastest and the most significantly. In our market in Charlotte, South Park is an area that I foresee as having the biggest impact quickly. Why is South Park a very appealing place to live? Because it's close to luxury shopping and is close to entertainment, and it is close to a lot of luxury employers. As the employers realize that they don't have to have half the space, or the space is nearly as expensive as they have, as their workforce is pared down, they'll be leaving. Malls, I fear, will close and be repurposed, and suddenly it is not going to be as luxurious or as high demand to live in some of the expensive areas. So I foresee some of those areas being affected first. So what does this really mean? It means a contraction in both our economic markets and our real estate markets. So what does this really mean to the real estate market? Let's talk specifically, since I am a realtor, not an economist. This graph shows real estate prices in Mecklenburg County since January of 2012. So if you live in Mecklenburg County or the surrounding areas, it's pretty similar. And as you can see, the median household price went from $155,000 all the way up to $285,000. This has created a number of issues in the economy, one of which being a problem with having affordable housing. But clearly an 80% increase in just 8 years is a positive thing for individual homeowners. This reminds me very much of the real estate market in the 2005 and 6 timeframe, where the market is very healthy and people have what I call an irrational exuberance of this ongoing increase in prices. Now, what's interesting, as a real estate agent, people asked me for years, beginning in 2009, 2010, gosh, I wish I could have known that the market was at its peak. I would have sold my house then, or I would have made this investment decision then. And I said, yes, it would have been nice to have, perfect hindsight or have been able to see this then. What I've concluded in today's market is this is that time. I believe we have all the indicators telling us that this is going to be the time where we can take advantage of the top of the market to meet our needs. Now, specifically, I want to talk about trends over just the last 2 years. Specifically, we'll use August to August since I have those numbers in front of me. Right here are the property value increases on the average sale price in the greater Charlotte area as reported by our multiple listing service. As you can see, in just 2 years, prices have gone from $295,000 average to $351,000 average. That is an unsustainable increase. And people have asked me, well, doesn't that signal a really healthy real estate market? And it would seem so, but I'll tell you why that's not true. Right now, we have an artificial pricing structure because of demand. If you go back to basic economics, prices are determined by supply and demand. And right now, the supply of homes is extremely low. It's extremely low for a number of reasons, some because of good economics in the beginning, but now from the pandemic wise, because we have so few houses for sale. As you can see, over the last 2 years, we have had almost a 60% combined decrease in the number of homes for sale. So when you have such a dramatic decrease in inventory, while still having population growth, if you actually think of the population, it has grown significantly in the last 2 years. So we have more people and dramatically fewer houses. So what does this mean? It means house prices are going up. It means you're having these multiple offer situations that you're hearing about. You may hear from neighbors or in the news or on social media how this person sold their house in 2 days with 12 offers. That's not likely to continue, because the reason that's happening is because of this artificial price situation, because of the demand. So looking at a couple of statistics that I think are going to cause the changes in this demand is right now over 4 million mortgages are in forbearance. For those of you who may not know what forbearance is, forbearance, hang on, let me go back one, sorry. Forbearance is a temporary hold on your mortgage payments that your mortgage company allowed you to have because of problems in the pandemic. That sounds great. It does wonders for a family's income and their cash flow. However, at the same time, what it does is it creates an additional balance in their mortgage. Their mortgage balance stays the same, if not going up, instead of going down like it would if they're making their payments. So that is 8.4% of total home loans. Now, we are still very early in what I believe is the economic impact of this pandemic. And as we go into fourth quarter and we see the real layoffs begin, I would expect this number of mortgages that are behind or in forbearance to go up significantly. According to CNBC, in July, 32% of US households missed their monthly housing payment. Think about that. That's 1 in 3 homes didn't make their housing payment. And according to Fox News, in August, that went up just 1% to 33%. So basically holding steady, that we are at least 1 month behind. Now, that does not apply strictly to homeowners. Some of those are renters, but you do have to remember that a good portion of those renters are renting from landlords who have mortgage payments to make themselves, whether that be a large corporation, an apartment complex, or a 1 or 2 off landlord. Without the income coming in for those people, it's going to have an impact on their ability to pay for that house. With non-paying tenants, landlord debt will rise and equity will decline. And only a modest correction is needed in real estate prices to put many properties in a negative equity position. Now, I don't foresee a crisis like we had in 2008 and 9. But I do foresee a large number of people that with 6 months of forbearance in their payments and a 10 to 15% correction in the market suddenly have a position where they may not be able to sell their house. So now I want to talk for a minute about those people and what we can do now and what I believe is going to happen. Because why is this the best time to sell for years to come? We are at the top of the market, I believe, and I do believe we're going to see a shift in both demand and pricing. So what does this actually mean to you? That's what you're here for, right? Looking at this graph, and I want to explain this, I believe that we are going to see a 15% correction in the market. So in order to make these next slides make sense, we're just going to use that as an assumption. So assuming that we have a 15% correction or reduction in real estate prices, and I'm going to make an assumption that we're starting with a $350,000 house. If you sell that $350,000 house today, and we're going to assume you have a $275,000 mortgage on that house, then you will have $75,000 worth of equity to put down on the next house. Sounds pretty good, right? Then you have the ability to avoid PMI, etc. If you were to wait till that 15% correction happens, that 15% comes dollar for dollar off of your equity. Your mortgage company doesn't say, we're going to reduce the balance 15% because we know the economy changed. You still owe them just as much money. So what that does is that shrinks your equity from $75,000 to $22,500. Now that doesn't feel very good, and it changes what happens to you in your next home. We're going to talk about the risk of waiting to your cash flow now. We're going to talk about the monthly payment on your next house. And let's just assume you did that now and you sold that $350,000 house. and you use that $75,000 worth of equity as your down payment on the next house. Well, at today's mortgage rates, believe it or not, we are seeing mortgages at 2.7 to 2.8% on a 30-year fixed rate. You will be looking at a mortgage payment, principal and interest of about $1,115. If you wait until that market changes 15%, then your house price comes down and the house price you're buying comes down. We're going to assume you're making a move to a similarly priced house, just for sake of argument. If you're going to a bigger house, this problem becomes even worse. But if you make that 15% correction, sure, you get the next house at a $52,000 discount because it went down just as well. And that may sound like a good idea. But if interest rates have changed and you've only got $22,000 to put down, let's just say interest rates go to 4.5%, which we've had interest rates that high as recently as the last 12 to 18 months, then your payment would be almost $1,400, even though the house costs less. The same house, if interest rates were to go up to 6.5%, which I personally believe we could see in the next year or two, then you're looking at a payment of $1,738. So the amazing impact that that's going to have on your monthly budget is going to significantly increase your costs, or potentially make it unaffordable, so you'd have to have a less expensive house that maybe is not the house you wanted. Now, you also may ask, okay, great, that's if you are selling a house. But if I'm just a buyer and I'm just a first-time home buyer, then this really isn't affecting me, is it? And I believe it is, and I'll show you why. If you're a first-time home buyer and you're going to buy a $250,000 house and you buy that today and you take advantage of that 2.7%, your monthly principal and interest payment on that house is going to be $963. Let's just say we have a 15% change and that house of that price goes all the way down to $212,500. If interest rates go up to 4.5%, your payment would still be going up to $1,022. And if we have an increase in interest rates that's even more significant, that payment can go up if interest rates go to 6.5%, all the way up to $1,275 just for principal and interest, even on a much less expensive home. So it's really important to me that you understand what is going on in the economy right now. And I really want to speak to those people that have asked me, what's going to happen in the future? Or why couldn't we have known what was going to happen in the past? Because this is one of those rare opportunities that I think the signals are all right there in front of us. And I think this is the opportunity to take advantage of this. And what I'd like to do now is offer to open the floor to questions. I'd like to talk this through if anybody has any questions on any of the particular slides. Of course, we would be more than happy to talk to you offline or come to your home and do analysis of the market value of your home. I'd be happy to talk to you about what kind of house you can afford if you're looking to buy a house. And anyone on our team would be happy to help. And I know we've got most of the team members here on the call. So I'm going to take a pause. And first one I'm going to introduce actually is Amanda. Amanda Cood is our client services manager with the Wachter Group. She's the one that keeps us all in line and supports us with our marketing, our paperwork, and our scheduling. And without her, we would not be nearly as organized. So Amanda's been tracking questions, and I'd like to open the floor now. Anybody would like to say anything, just go ahead and unmute yourself and let us know what your question is.
Yeah, Rob, that is actually one of the common questions I get a lot with people that they hear about the term, it's a seller's market, there's less houses. Great, I can sell my house, but what's the benefit in buying right now because the prices are high? And you made the point exactly that even if you're paying more now, considering the interest rates that is its lowest in at least 40 years, it's still a benefit in both ways.
Exactly. One of the things that people do ask occasionally is, well, does this mean I should just sell my house now, even if I really wasn't thinking about it? And I would never suggest that. One of the first things we ask people when talking about, is this the right time to move, is how does this fit into your life plan? If your life plan doesn't suggest moving, then I don't suggest you make a move. We could be talking about an investment opportunity or the opportunity to change investment properties, but we certainly wouldn't suggest someone go make a move that wasn't for them anyway. Thank you, Mel. And Mel is one of our senior agents on the team, does listings and works with buyers. Thanks, Mel.
Rob, it's Casey. I have a question.
Mm-hmm.
You said that we saw 4.5, maybe 12 to 18 months ago. What do you think would have to happen for it to jump substantially like that? I know you mentioned a lot of the bankruptcies. Do you think if we have more of those, that's going to affect it? Or do you think there's something specific that could happen that could make it jump back up?
Mm-hmm. Well, that's a great question. And I think that the answer is interesting in your question, is that if you look at history, and actually I thought I had a slide on interest rates, but I can see if I can pull one up. If you look at history, 4.5% is such a good low interest rate that hearing anybody ask in today's market, what happens if it jumps all the way back to 4.5% is a little bit interesting. 4.5% is still on the low end of average. The reality is that a move from 2.75 to 4.5 can happen in just a matter of months, depending on what happens in the financial markets. I don't want to make a very specific prediction, but I do know that the stock market generally behaves differently than the bond market. But all of those rules seem to be out the window right now, because I don't know anyone that's got good economic sense that says, sure, in the middle of a pandemic with all of these things going on, the stock market should be at an all-time high, that real estate prices should be at an all-time high. It's counterintuitive to financial common sense. So to answer the question, Casey, I would say that I don't think a whole lot has to happen. I think that if anything shakes the creditworthiness of the United States, and we do see our economy falter more, that the 30-year Treasury notes yields are going to go up. They're going to have to go up in order for us to sell them, and that's going to affect the mortgage rates.
Rob, this is Jack. Isn't that contrary a little bit to what the Federal Reserve has said? They made some announcements saying for the foreseeable future that they plan on doing things that'll keep interest rates low. So that seems like that would be a contrary force to what you're talking about.
That's a great question. Great point, Jack. And I'm glad you brought that up. The Federal Reserve has mentioned that they plan to keep rates at zero for the foreseeable future, whatever that means to the Federal Reserve. Couple things. Number one, I don't know that they will be able to do that. I believe that there is an irrational exuberance about the market. I believe that there's just a refusal to accept that certain things are happening. And I don't know that things can be held that artificially low for that long a period of time. The other thing is, it is a common misconception that Federal Reserve interest rates are tied directly to mortgage rates. While they are somewhat related, they are not directly related. Federal Reserve rates really relate to the rates that the Federal Reserve Bank charges to banks or large corporations for short-term lending. Whereas mortgage rates are typically more tied towards the yield on the 30-year Treasury. The theory being, if somebody has money to invest and they want to invest safely, 30-year Treasury note is a safe place to go. If they want to take a little bit more risk, but not a lot more risk, then bundled mortgages are a safe place to go. So the mortgages have to have a cushion over the 30-year Treasury in order to make up for the risk that you would take for it. So there's a lot of different factors that go into this, and frankly, you're right, it is contrary to what you hear in some of the news, but it's my belief that we're still going to see that. And it is my personal opinion, not fact, that's for sure. I hope that answered your question.
Yes, thank you.
Amanda, I think you're muted. No, we're not hearing Amanda. I think she's trying to pass a question on to me. Okay, Amanda is on mute. Amanda, if you can unmute yourself. No, Amanda, the Zoom says you're still muted. Sorry for the technical difficulties here, guys.
Rob,
Yes.
it's Erica. Some of it was cutting out, so I'm sorry if I'm repeating some of what you said. But I have somebody still wanting to know the answer on this question as well. What do you think the real estate market is going to look like in the next 6 months? Do you feel like we're going to have more homes on the market and start seeing prices drop?
That's a great question. I definitely think we're going to see the inventory reverse by the first quarter. And when I say reverse, I mean the trends. It's certainly not going to happen overnight. But my expectation is that once the election is over, once the year is over, and as soon as we begin to see either an acceptance of long-term management of the pandemic or hopefully vaccines and things to make it safer, that a lot of people that have been considering moving but put it off because of that are going to suddenly flood the market. I believe we have a pent-up demand or a pent-up queue, so to speak, of sellers that have said, you know, I definitely want to move, but I just don't think now is the right time. My belief is that that is not the right way to look at it. And I do fear that waiting is going to not do them any favors. Does that answer that question, Erica?
It does for me, yes. Thank you.
Mm-hmm. Did we get Amanda fixed yet? Okay. Did we have any other questions that came in?
Beth asked, how quickly are homes selling in today's market?
That's actually a great question. In today's market, homes that are priced properly are selling within 7 to 10 days for sure. The exceptions being houses that are unusual in the location or the style, or houses that are overpriced. What is very reasonable and you can expect right now is that if a house is not selling, that it is overpriced. And right now, I'd say anything that's on the market more than 30 days is either a special case or needs a price reduction.
Thank you.
Mm-hmm.
Testing. Can you hear me?
We can hear you. Yay.
Yay! Sorry. I did have a few questions that were submitted before ahead of time. One of them is, you say the market is hotter than it's ever been, but I have a neighbor whose house has been on the market for 6 months and it has yet to sell. How do you explain that?
Great question, and that actually is pretty much what Erica had just asked. So I'll
sorry, I was
okay.
Focused on my microphone.
Nope, that's okay. But the answer is that, you know, essentially there's several possibilities when a house isn't selling quickly. The first is that it's priced wrong. The second is that it's got a problem with the house, and the third is that it's unique and has a very small pool of buyers that's interested. So I would say it's always one of those three things. Either it's a very unique property that has very few people interested, or it's overpriced for what the product is.
Okay. And I had a person who has rental properties. They want to know if this information applies to them
That is a great question. I believe that the trends in the market are very important to know if you are an investor, a real estate investor. I think there are a number of things that you could do right now, depending on the goals that you have for your money and in your portfolio. This could be a good time to acquire certain property if you can finance it at ridiculously low interest rates. Investors tend to look at property a little bit differently because they look at the return or the cap rate on it. You know, how much money am I going to make from it? Not necessarily what is the purchase price of the property. So buying property when you can finance it for such low interest rates can be advantageous. It could also be a really good time to exchange out property that may be underperforming. There are ways for you to exchange real estate and defer income tax on those gains. So if you have rental property and investment property, I would love to talk to you about whether it's still meeting your needs to determine whether a reallocation of that property makes sense for your investment goals.
Okay. I believe we've covered all the questions that were submitted previously. And I thank you, Erica, for taking over asking the questions that came in online. I was struggling there for a second.
Got it. Thank you.
Of course.
Rob, I've got a question for you that's come up a couple of times, and it's something that has a lot of confusion.
Mm-hmm.
A lot of us have aging parents that are currently trying to decide whether or not to sell or downsize or age in place with a reverse mortgage.
Mm-hmm.
Given the current market conditions and your senior designation, what is your comment about that?
That's a great question. It is a very individualized answer. I personally believe that reverse mortgages have a bad rap from a lot of history, and frankly, it's deserved because the product was pretty bad about 15 years ago. The product has really gotten better, but whether or not that's actually going to help someone meet their needs is a really complex analysis. And sometimes it depends on the family. It depends on the person's long-term care insurance, depends on the medical needs, and just what their personal goals are. That is someone that has that kind of question I would love to do a personal consult with, because there's so many different possibilities in answering that question that it would be hard to guess right off the bat. There are tremendous opportunities to use that product outside of the box people often think of it in. Many people have found that they can buy a house using a reverse mortgage, often allowing someone that is in their 60s, 70s to have a house of a much higher quality, maybe one story, maybe very accessible house for a price much less than they expected. Did that answer your question, Mel?
Yeah, it certainly did.
Great. Well, if nobody has any other questions at this point, we can wrap it up. And I really appreciate your attendance at this event. And if you're watching on Facebook Live, thank you for joining. We appreciate that. We'd love that you share this video out with others. This recording will be available if you ever want to review it. If you've only tuned in at the end or if you missed anything, we'll make sure that you have access to it on our YouTube channel and our Facebook page. And as always, we appreciate referrals and the goodwill of our clients and our friends. And thank you. It means a lot. Hope you guys have a great day.
Thank you, Rob.
Thank you.
Thank you guys for joining.